Welcome to Longview. Let's start today with a fast-paced thought experiment. Imagine waking up tomorrow morning to find every single bank across the globe receiving an urgent, non-negotiable flash bulletin, effective immediately. The US dollar is strictly banned from global trade. What do you think happens next? Now, your immediate gut reaction might be, so what? What does that have to do with my average paycheck? I don't import luxury goods from America. I don't dine at high-end steakhouses. Ban whatever you want. Trust me, it has everything to do with you. If the dollar disappeared overnight, you probably couldn't even buy your morning coffee, and you could completely forget about upgrading your smartphone next month. To put this into perspective, it would be like suddenly banning every software developer on Earth from writing code in English, or completely deleting the reply all, or confirmed button from corporate communication worldwide. Let's look at how this plays out in real-world international trade. Suppose you own a local electronics plant and you want to buy top-tier OLED display panels from Samsung in South Korea. Samsung's sales director looks at your order and says, "Sorry, we don't accept yuan or forints. We strictly require Korean won." You check your corporate account, but your bank is running completely dry on one liquidity. So, you turn to a Saudi oil sheikh. "Hey my friend, I'll buy your crude oil using yuan or forints. Then I'll ship that oil to Korea, sell it for won, and use those won to buy my display panels. Deal?" The sheikh takes a puff of his cigar and looks at you like you've completely lost your mind. "Sorry, young man, we only take US dollars, or I suppose you could bring me a herd of top-grade camels instead." See the pattern here? Without the dollar, international trade wouldn't grind to a complete halt overnight, but its efficiency would collapse off a cliff. Companies would be forced to bleed massive amounts of time and capital managing FX exposure, clearing complex multi-currency payments, and hedging volatility. Ultimately, every single penny of those extra costs gets passed straight down to consumer price tags. Every multinational firm would be forced to turn into a full-time, speculative FX dealer, wasting endless bandwidth just proving that their local currency actually holds value. And that brings us to the core of today's analysis. The greenback's ultimate fortress today isn't just the sheer size of the US economy, it is the overwhelming network effects accumulated over decades. The more people who use it, the lower the transaction costs. And the lower the costs, the more players get sucked into the system. It's identical to WhatsApp or WeChat. Everyone uses it not because the user interface is flawless, but because your aunt, your boss, and your local grocery clerk are all on it. Today, we're stripping away the noisy geopolitical conspiracy theories. We are looking purely through the objective lens of market depth, transaction friction, and institutional mechanics to see how the dollar became the indisputable WhatsApp of global finance. Whenever financial analysts explain why the dollar is unavoidable, they throw around a magic buzzword, the petrodollar. But very few people actually understand how this architecture was engineered behind closed doors, or how brilliantly elegant its internal logic really is. Let's rewind to the early 1970s, the site of the biggest structural rupture in modern monetary history, the breakdown of Bretton Woods. Put simply, America had previously promised the world that $35 could always be redeemed for 1 ounce of physical gold, but the money presses ran too hot, US gold reserves dwindled, and President Nixon stepped up to announce that gold convertibility was officially suspended. The world was stunned. If greenbacks could no longer be redeemed for gold, weren't they just pieces of paper smelling of fresh ink? The dollar index went into freefall. The world wanted out. Enter Washington's premier diplomatic strategist, Henry Kissinger. He flew to Saudi Arabia for closed-door negotiations with the House of Saud. Kissinger's pitch was blunt. Look, your nation sits on top of endless oil and sand, and your geopolitical neighborhood is, to put it mildly, hostile. Your security guarantees are virtually zero. What if America guarantees your survival? State-of-the-art fighter jets, advanced radar defense, a total military umbrella for the royal family. But there's no free lunch? I have one condition. The Saudis asked, "What condition?" Kissinger held up a finger. "From this day forward, no matter who comes to buy your oil, whether they are British, Japanese, or German, you will accept strictly and exclusively US dollars." The Saudis agreed. They had to sell their crude anyway. Trading oil for bulletproof national security was a masterstroke deal. And thus, in 1974, the tightest commercial marriage in economic history was born, the petrodollar system. While historians still debate the exact nuances of those closed-door talks, the macro reality was undeniable. A closed-loop macroeconomic triangle was formed. First, everyone on Earth needs oil to run factories and power grids. To get oil, nations had to export real goods to America to earn dollars. Second, Saudi Arabia and OPEC accumulated staggering mountains of dollars that they couldn't possibly spend internally on real goods. Third, what did they do with the surplus? They funneled it straight back into buying US Treasury debt. This is what macroeconomists call petrodollar recycling. America issues currency, global trade generates relentless structural demand for that currency, and capital flows right back into US Treasuries. It sounds like an unfair superpower privilege, doesn't it? But let's look at the pure economic logic of why the market continues to choose this voluntarily today. The key word is volatility. Imagine Chile, the world's top copper producer, trading directly with India in Chilean pesos or Indian rupees. In international FX markets, emerging currencies can swing 5% to 10% in a single trading session. A Chilean mine operator works hard all year, projects his profit margin, and on settlement day, the peso suddenly devalues. By the time he clears the funds, his entire net margin is wiped out, costing him 2 new excavators. Commodity margins are razor thin, they cannot absorb wild FX swings. Traders require a poker-faced currency anchored by a deep, liquid financial market. Settling in a predictable unit reduces foreign exchange risk and allows corporations to hedge seamlessly via mature futures and options markets. The dollar serves as that global price anchor. If the petrodollar was born in the traditional industrial era, the dollar's role in today's high-tech landscape is even more critical. Take the processor inside the smartphone in your hand right now. A single semiconductor's journey looks like this. The architecture is designed in Silicon Valley, California. The hyper-complex EUV lithography machines are built by ASML in the Netherlands. Ultra-pure chemical reagents are shipped from specialized suppliers in Japan. The silicon wafers are etched in TSMC's clean rooms in Taiwan. Finally, the finished chip is delivered to Foxconn in Shenzhen for final assembly. Think about that. One tiny component circles the globe multiple times across 4 or 5 distinct legal jurisdictions and currency zones before it even turns on. Imagine if we ditched the dollar here and mandated local currency settlements at every single node. The finance department would collectively resign by tomorrow morning. Step 1. Taiwan buys chemicals from Japan, swapping new Taiwan dollars for Japanese yen. Step 2. The Netherlands sells equipment to Taiwan, swapping NTD for euros. Step 3. The final buyer pays Taiwan, swapping local currency back to NTD. By the time that phone reaches your hands, the price tag would double. Why? Because banks take a cut on every currency conversion. Even worse, because FX markets move by the second, firms would have to spend fortunes on options and forwards to hedge against sudden spikes in the yen or euro. In corporate finance, these are called transaction costs. The more complex the supply chain, the higher the friction, until it completely consumes corporate margins. The universal answer engineered by global markets? Everyone prices and settles in US dollars. The Dutch machine is $150 million. The Japanese chemicals are $5 million. The Taiwanese foundry fee is $50 per chip. Here, the dollar isn't a political weapon, it's the financial Esperanto of global industry. You can choose not to speak it, but your administrative costs will blow out so badly that you'll be priced out of international competition instantly. The dollar is the invisible lubricant of global supply chains. Now let's examine an official dataset that seems completely counterintuitive on the surface. According to the triennial statistics from the Bank for International Settlements, BIS, approximately 88% of all global foreign exchange transactions feature the US dollar on one side of the trade. To be completely precise, this does not mean 88% of all money in existence is dollars, because every FX swap involves 2 currencies. The statistical sum totals 200% across all pairs. Still, many people find this figure outrageous. They ask, if Hungary or China trades directly with Brazil, why don't we settle directly in real or forints? Why route all the way around the world through New York? Are Americans charging a toll on every transaction? The reality is far more pragmatic. In financial markets, the direct path is frequently far more expensive than the detour. Think of the global FX market as a massive bazaar. The local currency to USD counter sits right at the center entrance. Billions of dollars change hands every second. Oil importers, tech giants, and global pension funds are all active here. Because there are endless buyers and sellers, the market boasts deep liquidity. The bid-ask spread is microscopic. You can convert millions with virtually zero slippage. Now walk over to the dark, dusty corner of the bazaar with the sign reading Forint directly to Brazilian real. Nobody has visited that counter in weeks. If you're a corporate treasurer wanting to swap billions of forints directly into real to import paper pulp, the bank dealer gets nervous. Real is extremely illiquid in this region. If I take your forints and hand over my real, what happens if bad news hits Brasilia tomorrow and I'm stuck holding this exotic exposure? To insulate against that risk, the bank charges a massive risk premium. The bid-ask spread is so wide that a chunk of your capital evaporates before the deal even clears. So, quantitative institutional desks engineered the cheapest bridging route. Step 1. Convert local currency to US dollars, a massive financial highway with negligible spread. Step 2. Convert US dollars into Brazilian real, another hyperliquid highway. Even though it looks like a multi-step detour on paper, the combined fees of two hyperliquid markets are miles cheaper than slogging through an illiquid, muddy dirt road. In macroeconomics, this is known as a vehicle currency. The dollar acts as the central ferry of the financial world. Liquidity itself is a distinct commodity. By the end of this first episode, the structural picture becomes crystal clear. While the dollar's dominance decades ago was undeniably tied to geopolitical muscle and the Saudi oil pact, today's dollar system no longer rests merely on one nation's power. It is anchored by the self-reinforcing network effects built by global trade, financial liquidity, and market participants. It functions like a global financial highway network. While the toll collector certainly profits, global merchants continue driving on it because it offers the lowest fuel consumption, the fewest flat tires, and the highest speed. There is a classic adage in economics. Once an institutional standard locks in, the cost of switching standards is vastly higher than continuing to use it. The greenback faces undeniable challenges today, but it remains the deepest, most liquid, and lowest cost international currency available. That doesn't mean this status lasts forever. History teaches us that no reserve currency holds the throne permanently. But until an alternative emerges that can simultaneously replace the dollar's trade, financing, and reserve functions, the network effect endures. Which brings us to an even more fascinating question. If global exporters earn endless streams of dollars, what do they actually do with the cash? They obviously don't stack paper bills under the CEO's mattress. Global central banks accumulate hundreds of billions in trade surpluses, what we call foreign exchange reserves. Have you ever wondered why central bank governors, while publicly voicing concern over dollar risk, continue buying US Treasuries at a breakneck pace behind closed doors? What are they getting out of this setup, and how do dollar reserves become a sovereign nation's ultimate life raft during a crisis? In our next episode, we unlock the shared secret of global central banks. Why is the entire world hoarding US dollars? This channel does not offer investment advice. We aim to polish the precise lens for observing a world in structural transition. This is money and macroeconomics. If you found this deep dive valuable, hit like, subscribe, and stay rational. See you in episode 2.